Hello, everyone. Welcome to another TANET webinar. So risk management, right, guys? One second here. Okay. Yeah. So risk management, it's the most important thing, and which is least bothered by many traders, especially the new traders. So this webinar is good for if you are new. This is especially good for you, and if you are experienced trader, and it's good for you as well, because we often think that, oh, risk management is just theoretical thing, right? We are here to make money, and we want to make money. That's the whole point of trading. But we forget to realize that preserving the money is also important. If you don't have money, if you are rash with your cash, and you are not following any kind of risk management methodology, then you will lose the money on 1-2 bad trades. And when there is actually something worth, where you are in a bull market, or you have these A plus setups, you would not be able to capitalize because you never had risk management to save your capital. No matter how good a system you have, no matter you have EMA cloud system, you have some VWAP strategy, you have some investing strategy, you have great knowledge of biotech as a biotech investor, does not matter what you have. One second. Yeah. So my point is, guys, does not matter you have a great system. If you are not following a risk management and the concepts that I'm going to discuss here, you will not have a consistent growth. You will keep running in a loop, and we will talk about it. So let's deep dive into risk management today. We will talk about position sizing and risk reward, and how to manage risk with stocks and options so that you can have optimal results in trading and investing. So what are we going to cover today, guys? So we're going to talk about what is risk management. We'll just go into some theory, what does it mean? And then we'll talk about our mindset. A lot of those things I already talked in the mindset webinar, but we'll discuss when it comes to risk, how does our mind work? We'll talk about that. Then we'll talk about the concept of R, the most important concept that can change your trading, investing career forever. Then we'll discuss how risk management differs from trading, swing, and investing, although we are going to focus more on day trades and swings in this webinar, but we'll discuss what's the difference. Then we'll discuss the risk tolerance and how to calculate the risk. What is a risk tolerance? And then talk about the risk reward ratio, the most important concept, and the position sizing, stop losses, how to have proper stop losses, when to have the best entries so that your risk management is most efficient and most optimal. Grading your trades that I talk about every day. We'll just review what I mean of grading your trades as per different risk levels. Then we'll talk about options trading, because option trading, the sizing and risk analysis is a little different. We'll discuss that. Then scaling in, scaling out, which I don't see a lot of people doing. And I know that some people with the small accounts have those issues, but this is very important. And then we'll talk about how EMA cloud system, Ripster EMA cloud systems are used to manage the trades and our risk reward. So guys, what is risk management? Stock market trading and investing risk management is process of identifying, analyzing, and taking steps to minimize or control exposure to risk that can affect our investments. It's just theoretical term. But the point of risk management is, guys, to make sure we are making money while not losing the money. We will lose money. Losing is part of the game. If we are doing 20 trades, we will lose. Even if we lose in those 8 out of 20, that's fine. But risk management will teach us how to make sure we lose less, we make more. And when we lose, the losers don't go out of hand. And then we consistently grow. And that is the risk management. The risk management is to stay in the game long enough to see consistent growth, the financial independence that you're looking for. That is the risk management. Because if you don't follow risk management, then you are only looking at one side of the coin, because these are two sides of coin, and they go hand in hand. So anyways, so when we do risk management, we can preserve our capital. Example of this is a lot of investors, traders who came into the market like COVID, right? So many people came on Twitter looking for alerts, looking for stocks, and nobody had idea what risk management is. I've been shouting about this for a long time, but nobody cares about education. They wanted quick money, short money. So they took this, whatever somebody said on Twitter, buy this, buy that, hundreds of example of cult stocks. And then when they buy the stock, as long as it's running, that is fine. And when it's breaking a certain level, they are clueless and they're stuck holding the bags, which I will talk in the next slides. And they hold it for eternity. They don't know. And when the market really became bullish, they had no money because they never preserved their capital. They did not follow any kind of risk management. So you have to preserve your capital. You have to avoid big losses. Losses are part of the game, no problem, that's fine. But when you're doing emotional trading, revenge trading, when you are, then you will never preserve your capital. You will never preserve your capital. You'll keep thinking, oh, I want to make money, I want to get what I lost, I want to make. You will keep losing it. You have to be systematic. Consistency will come when you follow proper risk management methods. That's only way the consistency will come. Psychological comfort. If you have a predefined risk, following your methodology, if you trade a risk, you will not be stressed because you already told yourself that if I'm in this trade, I'm willing to lose this much. Compared to you take a trade without a risk analysis, and the moment it ticks little low and you're like, oh, what should I do? Hey, Rip, you think it's a good place to buy? Hey, you think it will bounce? Your psyche is going to be messed up because you never did a risk analysis. So your psychological, because trading investing should be stress-free. It can only be stress-free if you do, proper risk management. Longevity and success. So all these things count for the same. What defines your risk management? Your technical knowledge. See, your fundamentals and will give you conviction, but your technical knowledge will tell you where to enter, when to exit. So technical knowledge is must. Your proven and repeatable system. Without a repeatable system, your risk management won't work. And you need to have repeatable setups, because those setups tells you that if I'm having an entry here, yeah. So everybody wants to know how to make money. That's the thing, right? The short money never survives too long. The short money, you make the money just like people who came in COVID. A lot of them made a lot of money. They lost what they made and then even lost more. And then they went home. So you have to define your risk management. So I was talking about what defines it: your technical knowledge, your repeatable systems, your position sizing. For example, I know, right? Just to give you an example, so I know if I'm doing a gap down setup, using my EMA cloud system, I know if the gap fades, I will make 3-4 times. But if the gap does not fade, it holds, I will exit right away when my system tells me to exit, because this has happened 10 times before, just like what I discussed in the last webinar. So I know this will happen, this will repeat, this behavior will repeat. So then only I can manage my risk. I know if a stock falls under $10, most likely it will go to 7, 8. I know if a stock goes under IPO lows, there is no bottom. I go back to examples of so many IPOs. I go back to Rivian as well, right? When it breaks 50, because everybody was Rivian is the next Tesla. My system saved me, right? I told many people, when any stock breaks 10, just cut your investment. It's not worth it. And the stocks went from 10 to 3 to 4 and 1, even pennies. So I know the repeatable personality. That's why I can manage the risk, right? So your goals, what is your goals? Your account size and your risk tolerance. These two will also define your risk management. Because if your account is small and you're taking too big a risks, so let's say your account is, just 10,000, and just on 2 trades, you wiped your whole account away. That's not a proper risk management. You have to trade according to your account. A lot of the mistake that traders do is they have a small account. If they have $2,000 account and they try to go with one trade of $1,000, risking 50% of their account, and that's a bad risk management. Because a good risk management should be according to your account. It should give you ample time for mistakes. It should give you ample buffer for mistakes. And when we are trying to get rich quick, we do not adopt that. So your account size defines your risk management and your risk tolerance. On $2,000 account per trade, your risk tolerance should not be more than 100, maybe 150, whatever. So, and your personality. If your personality is that you panic early and you are, you are very impatient, and all those things define as well. Some things we can change in the market as per our personality. Some things we have to define. If your personality is too impatient, then you have to, change your risk management accordingly. Or anything, don't try to do what somebody else is doing. You try to do what somebody else is doing, and his risk tolerance will be different. Like so many people try to follow, like when I say, if you're following some social media people and all that, they will be scratched. I will be scratched with the loss doing in a certain trade, but your whole account will be wiped off. So don't try to mimic others. Follow your risk reward. All right. So no or wrong risk management, trying to quickly make exponential gains that does not sync with your account, usually leads to bad results. Just like the example I was telling you about $2,000 account, and you are trying to risk $1,000. And I'm sure, a lot of things I'm going to talk about. Let me know if that has happened to you, and we'll discuss. So when we, as an amateur trader, we start to trade, we want to make money. We make some fluke money, we lose that money. Then we chase the lost money. We don't care about risk management. You just lost that money, man. I just want that money back. And then you lose more money, and you fund it because you want to try again, and you want to recover everything that you lost. You try to do some risk management, then you win few trades, and then you forget risk management because guess what? Hey, I think I got it. And then you lose everything in one single trade. Then you go back, fund again, those, I was there too, right? Because everybody don't have that luxury, because if you are doing a good job, you have good income, like a lot of people I talk to or even mentor, they are businessmen, they have, $1 million accounts, but they are losing $1 million accounts, but they have business to come back into the game, right? A lot of my mentorship students I talk to, so they come, and same like me, when I was working for Fortune 500 companies, I can work for 2-3 more contracts and bring few $100,000 back, fund it again and restart. But some of you can't. Some of you just have a saved money. You just have to start from a small account. So you don't have that luxury. But everybody else, they will keep going in this vicious cycle, trying to make money, fund, try to do some risk management, win few trades, become complacent, lose all in single trade, all that things that we discussed in the Trading Mindset webinar. So, but you sincerely need to try for risk management, because you want to make money quick, but you don't want to do risk management. And risk management takes discipline, and risk management sometimes won't give you crazy gains. That's a fact. With risk management, you can't, you can still grow, but if you completely throw it out of the window, then you have more to lose than you have to gain. Remember how many times, which I will talk about next slide. Actually, I'll wait for that. I'll talk about it. So risk management must become your habit. It must become your habit. You should not have to think twice about it. Your account size does not change the habit. If you blow a $2,000 account, you will blow 100,000 accounts, because your mistakes, you will keep doing the same. I give you $1 million account, you will do the same mistake. I did one mistake many years ago, and I lost $1,000. My account grew, and I did the same mistake. Then I lost $1 million, because account size does not change your habits. So if you have, your risk management will go with you. If you are doing a proper risk management with $10,000 account, you will do a proper risk management with a $100,000 account, because you have built an habit. Big account does not make you, invincible. So these are some facts you need to know. One bad trade should not define your whole trading career, guys. This line. One bad trade should not define your whole trading investing career. Tell me, have you spent time, creating your account? You had 10 wins, 11 wins, and we'll talk about it. We'll talk about that. It's more about the trading mindset, but I'll talk about it. So let's say you were in a trade, and then you lost everything in that one mistake. Let's say you were trying to short Tesla without any risk management, and you keep adding puts, and you're like, maybe it will reject here, maybe it will reject here. Or you're buying Tesla, like yesterday, when Tesla was going to 200. You keep buying the dips, ignoring the risk management, because you think maybe it will bounce here, maybe it will bounce here. And you don't realize, by averaging down, 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 you almost put your all margin account in it. And by end of the day, your account was half gone. Only if you did not make that one bad trade, your account would have been saved. One mistake, guys, one mistake will wipe it all off. So, and that is what risk management will avoid you. Of course, a lot of this risk management and the mindset are together, but it will help you. Yes, option I went up 20K in options in just a few days. I was so confident. I felt I would never lose, took all those profits, thought about how much I could make with more options, then lost it all. Yeah, we have all been there, we get complacent, and when we grow, we think, who needs risk management? I made $20,000 in options. Yeah, maybe I can make 100,000. Where else we should have followed the risk management once we make that money. As a trader investor, you should have to understand it's not always about to make money. It's all about also about preserving capital. When there is no risk reward, sit on your hands. When there is no setup, sit on your hands. When you have to too far away from risk is your entry, sit on your hands. Because you will be fine if you don't make money, but you won't be fine if you lose what you have. Because while making more money, you lose what you have. And that's the whole point. And then we chase, we run around in that vicious circle. So think about it. Avoid one step forward, 3 steps back. And most of the time, the traders who are failing are doing this. They take 1 step forward and then they take 3 steps back. So trading mindset, so a lot of things are related. The risk management. So what I'm trying to do, with the trading mindset webinar and this webinar, I'm trying to make, change your stubborn mind. Because stubborn mind is traders' biggest enemy. Your fight is with yourself, not with the market, not with anybody else. Conquer your mind. So what does, if we do not do risk management, we are emotional traders. It's that simple. What do we tell ourselves? Oh, it's okay. It can't go lower. If I'm long, it's okay. It can't squeeze me more. Come on. It's already gone so high. How high can it go? God will not give me another loser, right? I've been losing. I feel like, pity myself. Like, I have lost so much. God will take pity on me, and next trade, God might make me win, right? We've been there, right? So I lost so much already. What does one more loss make? How does one more loss make a difference? You try to, tell yourself that I have lost already. Many days you're trying to trade, and then you're like, who cares? I have already lost $1,000 for the day, another 400. How would it make a difference? And when you lose that another 400, then it strikes you. Oh man, I should have just closed the day with 1,000. Now I'm down 1,400. And then if you don't shut off your broker, then you come back and then like, I'm going to try again. So that's what happens because we didn't even follow risk management. You will stay money oriented and you will never be a goal oriented trader if you do not follow the risk management. You will constantly be stuck in fear of losing as you never predefine your risk, because you never predefine. You just don't know, oh, this is going to go, this stock is going to go, buy. And then moment you click it, you realize, oh man, if this doesn't work, it's going to be bad. It should be predefined. You will be in a vicious cycle of funding. You will have a good working system, but you will still fail. Right? Like I still have people who can't work with clouds. They come complain, hey, Rip, I don't know how you make it work. Because, because you're not even following the proper risk management procedures, right? You're telling me, oh, I got chopped out. Then why are you taking 100 shares? Take 10 shares. Don't try to make money. See what the system is doing. Proper risk management. Because when you become money oriented, your good system will also not work because you don't trust the system, because you don't have a screen time and you don't let it work. Your mind is defensive. It will give you hope and it will tell you not to follow your risk management. Your mind will keep telling us, yeah, it's okay. And you will become impulsive traders. Like what was it? There's a Boeing news today, right? You see Boeing news coming out. Oh, this might be bad news. Let me short it. Things like that. Ignoring the risk and, risk management. You will have to train your mind. The things we are going to talk in the next few slides, you will have to train your mind. It will take a long time to build risk management before you scale up. So follow quickly. All right, quick slide on the difference between the risk management as a day trader, investor, or a swing trader. For day trading, guys, it's relatively size is relatively more because we are day trading with margin as well, but there is not much room for error. There's not much room for error because we have a fixed stop losses. We have to cut it in if that doesn't work. It's based upon smaller time frame. It's day trading is more stressful. More discipline is needed for risk management. You need to be on top of the trades. You cannot take a trade and go to a meeting and then come back and you lose it all. Your decision making needs to be fast and quick. need more journaling of your system. Somebody was telling me the other day when we were doing the pre-market prep webinar, and he was like, Rip, I can't make those decisions quickly. Well, you have to. If you want to be a successful trader, you have to, especially if you want to be a successful day trader. Your fixed risk management methodology. When you're doing your risk management, it should be fixed. Swing trading, usually our size is smaller because our time frame is bigger. We are looking at 1 hour candles or daily candles. Based upon that is our risk. And we need our niche. We need our niche swing setups like DUOL that we were doing today, right? We already made money in day trade, and then we left a certain size. I don't care. DUL moved $15 today, but if it came back for $5 because I'm sizing for that big range, I know that it will move $10 up and down, and I'm fine with that. But versus if I was in a day trade, I could not handle that $10 move to the downside. And it was a repeatable setup. Dual, the swing that we did today, it was a repeatable setup for us. So that's how I know that I can have a good risk management on this trade based upon my repeatable setups. So just to give you an example that how that works. So my size is smaller, right? So once I go into the size position sizing, I will explain. So anyways, that was just an example. As an investor, position sizing, allocation, diversification, that is what matters more in risk management. There are weekly, monthly candles define our risk management. More due diligence is needed because a lot of fundamentals and a lot of those are needed. And market environment impacts our risk to some extent, right? Because if the market is selling off, it's a bearish market, the S&P is in a bearish trend, then you have to wait. It's different, right? But it's less stressful, bigger you can, and you need to scale in the concept of scaling in. Like last year when Tesla was breaking down, we were talking about 100 level, and we said, if you add some at 120 and then add some more at 100, you build in a position with risking the $100 so that when, and it bounced, those who, I don't know if somebody remembers when I was talking about that 100. So investors' risk management is different. There's a little different things that go there. But one thing, guys, don't keep averaging down in your investments, because a 33% drop will need a 50% gain. You are in a stock which is down 33%, and it will need a 50% gain just for you to break even. So, stop out, keep that winning chance for another trade. You hold a bearish stock for eternity, waiting for it to bounce, while 10 other stocks that you could have traded in that same time with the same capital, they went crazy. So opportunity cost. You didn't have any risk management. You are holding some stock like Lucid, which is so bearish. And not only you lost money, not only you are down 75%, even if you stopped at 50%, you could have used that capital in some bullish stock. You could have gotten out of Lucid, and maybe you could have bought Tesla. It doesn't matter if Tesla was $150 stock. It's still, it moves to 300, it's 50% gains, or if it moves to 225, it's decent percent of gains. So it doesn't matter. So you have to move and cut your bags and move on. So those are part of the risk management as well. So all right, guys. So now we get into the technicals, right? So what are the principles of risk management? Excuse me. So I've been talking about this for years. Fixed R, concept of fixed R, guys. How many of you on this call have a fixed R? Tell me, or you understand this concept. Let's see. Nobody? Should be somebody, at least my old followers. Yeah. So, yeah, good. So fixed R, guys, means that every trade, good. That's good. Good to see that, Salman. Yes. Yeah, daily max loss, but you often break your rules. I hear you. We'll talk about it. Yeah. So every trade, you should lose a fixed amount, guys. Always try to lose the fixed amount every trade. And I will talk about how you can risk more on your A+ setups. But when you're making a trade on bad setups, try to lose less. Because when you win, you try to win 2 times R, 3 times R. R can be anything for a small account, 100, 500, 2,000, to a bigger account is 2,000, whatever. It doesn't matter how many times you lose. Never lose more than R. It's better to lose R on your 3 setups than losing 3R on your one random setup. So what I mean is, if you're playing your repeatable setup, let's say you can only lose $100 on one trade. Better to lose. I'm not saying intentionally lose, but let's say you were in your repeatable setup, it's not working. One didn't work, you lost 1 hour. Other didn't work, you lost 100. The third one didn't lose, you lost 100. That is fine. When the fourth one starts to work and you make 3R, you recover all that. But the problem comes is in one trade, when you lose 3 times your 100 risk, you are supposed to only lose 100 a trade, and you are losing 300 a trade. That's not going to work. So you have to fix, have to have a fixed R, guys. Risk fixed R. When R is fixed, it makes your trading systematic, methodical, and it's not that tough. I will show you, it's not that tough. When you start trading, you might load up and experience a series of losses, 2K here, 3K there, and then you might make 6,000 in some trade. But then, but then you lose 500 and then you lose 10,000. Just like up, down, up, down. There's no consistency, no consistency in your losers, no consistency in your winners. You do not know which of your setups are good, which of your setups are bad. You have no clue because you're making some here, losing some there. When you define R, then you will know which setup is working. If you watch my YouTube videos, I often talk about that. Salman, you should remember, or Vinod, because I often talk about that this was my R and this much I made. I risked 50 cents. I made $3, 6 times 50 cents. This also helps with your targets and stuff. Once you know you can keep your risk and losers consistent, then you find a trading system that, when it works, helps you win big and cover all your losers. Because if you look at today, we were trading U, right? So we were trading U. So additionally, our U became like 6-7 times multiple risk to reward trade. And if we talk about scaling in, scaling out, so that big win would have wiped any losses, right? So we were trying to short win. That's fine. Win was little green and then it didn't work. We got out. We didn't hold win till it went crazy losses. So you have to find your system which gives you 2R, 3R at least. If you're losing $100, you're supposed to make $200 at least, or $300. No random trading. No just, I mean, I understand scalping and all that is different, but all that should be under your risk reward. If you're scalping, your size should be smaller. The system could be anything. You could be having a momentum trading, short selling, options trading. You can be a pattern trader, or you can be a penny stock trader, whatever. But you need to find a system that gives you 2 times or 3 times your risk. And risk is how much you risk, and we talk about in the next slides. So common issue with the traders who fail to find consistency. They are making less R than they think. Their R losers are bigger, right? And for example, if I want to, let's take one example. So let's say, okay. So this was or U, right? So U is working for you, and you are risking 22 to $1 a share, and you get out making 50 cents. Okay. And the stock went to make 26. It went to make 3 times your risk. No, but you got out right away making 50 cents, half your R. And then you were short win. So you were short win. And here, let's say you were risking 84 and you shorted 83. It didn't work. You kept holding it. It went to 84, you kept holding it. It went to 85, you kept holding it, and you finally stopped out at 86. You are planning to risk 100, 1 hour, and you gave away 3 hours, $300. And where you were supposed to make risking 100, where you were supposed to make at least 300 or 200, you only make $50. That's not going to work. So you are red for the day. Even though you were right one time, you were wrong other time. You were right here, you were wrong here. But you are a net loser, because when you were right, you didn't respect your RR. You did not respect your fixed risk. So that's the problem. So So they are making less than they think. Their R losers are bigger. They do not care about R. You don't really care about R. You think, okay, this is a short, I'm going to short it, just hit it here. You just hit it here, like you hit short right here, and then it squeezes. Or Boeing news comes. Yes, that is what I will talk in scale in and scale out. I will talk about it in the last slide. So like you heard the news, you don't care about what are, let's short it. The news is really bad. This is going to go down, and you hit it, and then it squeezes you. So that's let's see. So that's the bad. That's where you don't care about the R. So they think it's a theoretical concept. Basically, they say, I know what is this? Risk, reward, fixed R. These are all theoretical. I'm here to make money. If I get a home run, I'm a winner. Who cares about R? That's not how it's going to work. They exit their trades early. They're very impatient. They do not trust the system. They keep watching the P&L. They never hide on P&L. They never watch the chart and system. They are holding trades too long, which are going against them. Their technical system is not efficient for R to work properly. So if you are telling me, like I know with someone it happened who is on the call right now, if you are telling me that you were long on you were long on the you were long, and when it dipped here, you stopped out, and it went to keep running, then your system is wrong. Why are you stopping out here? What is your system? A VWAP? I don't care, whatever your system is. Then your system is wrong. So that is the other problem. Their technical system is not efficient for their R to work properly. Their risk is too big for their account. The risk is too big for their account. We are trying to trade Tesla. You are trying to trade Tesla. And you are trying to buy Tesla over EMA clouds. And your account is $2,000 and you bought options worth $1,500 or $2,000, or let's say $1,500. You bought some lotos, and by the time Tesla pulled back, your $1,500 were down to $500. Your R is messed up. Your account is $2,000 and your R is what, $7,000 on one trade? That's not how it's going to work, buddy. So that's too big versus their account size. And not adjusting your position size according to your R. We do not adjust our position size, because if I'm buying, let's say, if I'm buying 1,000 shares of you, and then I'm trading Boeing, I have a big account, I try to buy 1,000 shares of Boeing too. You have to, your only thing that stays stagnant is your risk. Your size is variable, guys. Your size is variable. If you're, you can't, if you're taking 1,000 shares, if you're taking 1,000 shares of penny stock, you cannot take the 1,000 shares of something which moves $2-3 in 1 minute. So not adjusting your position size according to R. And if you take an option which has 50-60 delta, and the stock moves $3 and your option goes 60%, you are not really managing it properly. When your performance is measured against the amount of risk to achieve, the result is more realistic to determine how good your trading is. If you go back, look at what you've been doing for last 1 month, look at all your trades, and try to see how much did you risk and how much did you make. Then you will realize how good your trading is. If in last 10 trades, you risked $1 and you were making 20 cents, 30 cents, that's not good returns on one risk. One big loser will wipe everything. So only way you can measure if your system is working or not is based upon your system, right? So let's go back to take a few examples. So let's just say this was just talking about the shares. So Roku was $1 risk, or let's say $1.50 risk, and then Roku went to make $78. 3 or 4 times my risk. Let's say Rivian, my risk was 70 cents and I made maybe $2, let's say $2.10, 3 times my risk. So then I can tell myself that my system, when it works, I can make 3 times my risk. But if you do not know that, if you're just taking here, you took the Rivian here, something there, loses here, then you don't know how good your system is. So I know how good my system is, because when it goes, if the stock has in earning seasons, it's it really moves. So there's only way to figure out if your trading is good or not is to measure how much you're risking and how much you're making. Last piece of puzzle is to determine your overall success of any given strategy. With all of your trades tagged together, you can quickly figure out if your strategy is working or not. So guys, this might look a lot of theoretical and all, but once you start doing it, it becomes a second nature to you, and you will be automated to do it, and you will automated to find those hours. And I agree, if you are just part-time trader who is just trading half an hour on the phone, yeah, you can't figure all that out, and you should not be even prioritizing to be a professional trader. These things will make you a professional trader. Yes, if you're an investor, even then the risk management will make you an experienced investor or swing trader. Okay, risk tolerance. What is a risk tolerance? How you calculate your risk? Your risk tolerance should allow you to remain in a trading game long enough to see profitability. Basically, how much you can lose, how much can you, just like I said earlier, if you have $2,000 account or a $5,000 account, let's say $5,000 account, and if you are losing on every trade, let's say $200, you know, you can make 25 trades. You can make 25. You have 25 trades to grow your account. See how you are doing. But if your risk tolerance is, that's your risk tolerance. Your risk tolerance is not 2,000 per trade. It's not. Because if your risk tolerance is 2,000 on a $5,000 account, you will only have 2 chances, and then one bad trade you will lose it all. Risk tolerance is the size of the stop loss, not the total account value, right, per trade. Textbook risk tolerance is 2%. Me personally, you can go Google study. A lot of people tell you to have 2%, 1%. I don't go by textbook, but it's a general thumb of rule. I decide what my risk tolerance is, based upon how my trade account is going, how my trades are going. I increase or decrease my risk tolerance, but ideally you should have it as 2% per trade. You should be able to lose. As a learner, your risk tolerance is negligible. The goal isn't to earn money initially. The goal is to make trades that yield multi per hour. So this here, guys, this is the biggest problem. Biggest problem. Deborah, mental stops is what I use always. This is the biggest problem, because you come to start trading and then you use your full risk tolerance. Even if you come with 10,000 account, you use your full risk tolerance. You try to risk, because you don't even know how many hours can you make, but you just want to make money. So that's the biggest problem. So when you start, your risk tolerance should be low, maybe 0.5, 0.05% of your account, just to figure out your systems, your setups. Doesn't matter, you lose 0.5 on 10 trades, half a cent percent on 10 trades, still you're fine. Your account is still intact, but you're learning. So your risk tolerance should be negligible when you're starting off. I see this is the problem I see again and again. The people who are still struggling, they just come back. They still have high risk tolerance. And I have seen improvements on people who have changed it, who have reduced their risk tolerance, trying to make good trades, trying to figure out what works for them. As you gain confidence and start to see consistency, gradually grow your R. That's the way to do it, guys. Yes, of course. Your entry is supposed to be on R. Of course. No, there is no question about it. Sometimes you're not getting a good entry, then you reduce the size. Remember, R is fixed, but your size can vary. If I'm risking $1,000 and I realize that if I buy here, I will lose 2,000, then I just buy half my size. We'll talk about it next slide. First, prove to yourself that you can win a certain number of trades to see profitability before increasing your R. I don't know how many times I have been talking about this, but this is the most important thing, guys. This is the most important thing. If you are regularly losing more R than your system accounts for, you should not increase your trade size. Never. And it's not that difficult. If let's say you came to the market with $20,000 account. If per trade you're losing $50, that's nothing. You're learning. You're trying to figure out your system. But no, everybody wants to trade randomly, wants to make that big money. One trade, they lose 1,000, other trade, they lose 200, third trade, they lose 3,000. And then they realize, oh, my account is down to 10,000 from 20,000 because I have no clue what R is. And I have no clue what keeping R as, negligible is. So I hope, I think this might, a lot of you might understand, because I get a lot of DMs on those who are struggling, and you might understand what I mean here. So guys, risk tolerance is based on your actual cash value account, not your margin account. You can trade with the margin, but that's not the risk, right? That, your actual cash, how much cash you have, that defines your risk tolerance. Don't, if you can trade 4 times, if you have 50,000 in your account and you can day trade with 400,000, doesn't mean that you risk 4,000 per trade. Okay, that's the margin. It's loaned money. Your risk should still be, if you're 50,000 account, your risk should still be according to that. All right, very important, very important. So we'll go into more technicals, but this is important before we go into the formulas and all. Balancing your risk. Okay, read up. If you take 10 trades in a day, you risk 100 on the first 9 and then risk 1,000 on the 10th trade. It does not matter if you have 90% success rate. You will be a losing trader. This is the element of risk management called balancing the risk. You never want to have one trade weighed so heavily with risk that it has power to erase all your winners. This is important. That's why I'm repeating it in few slides. Even if the final trade has 2 to 1 profit loss potential, you're risking 1,000 to make 2,000. It's still a poor decision, because risk of that trade outweighs the average risk per trade. Yeah, yes, Chetan, we'll go in when I go to that slide, I'm going to discuss that. So many traders will adjust our risk per trade throughout the day based upon our performance to adapt to the greater market conditions, right? If you had made more money, like I do, right? You have made more money in the open, then you can risk, some more. You can risk on lottos, 100% on lottos, things like that, because we want to increase our profits. The difference is smart traders adjust risk in smaller increments. So impact of winners or losers will not have a strong impact on the overall performance. If you won 3 trades and you get overconfident and then you just increase your size too much, that's not how it's going to work, because you're going to skew your overall, profitability. If I risk 100 on first 6 trades, I may decide to increase my risk to 150 or decrease it to 175 to 75 on the 7th. But I would not make a drastic change, in middle of the trading day. Many beginner traders will have a great day until they decide to swing for the fences and take a high risk position, which they think is like the best setup. If they lose on that high risk trade, they will give back their entire profits for the day, and they potentially go into the red and probably start revenge trading. It's a disappointing loss, affects your psyche. What is even worse is loss of the confidence, because that one loss made you wipe everything. This is the type of behavior that can quickly cause a trader to fall into a cycle of emotionally fueled trading known as revenge trading, trying to quickly make back the losses by taking increasing risky bets. To avoid this situation, you must balance your risk across all your trades. So if a final trade is loser, it does not ruin your day. How many of you here are, which they say, oh, I know, this trade works. I'm always right, but I'm still not making money. I'm mostly right, but I'm still not making money. That's the reason. Yeah, good. So I'll talk about a few points in the next slides. When we have FOMO, we have more FOMO. You can always add 1/3, 1/4 of your R. That is fine. It's fine. If you want to make 100 and you're just making $10, that's fine. You risked $5 to make $10. Who cares? You still did 2R. Okay, SPY went, how many points SPY went? Does it make a difference? Okay, let's look at SPY. Okay, I'm going to talk in the share terms, okay, not in the option terms. So SPY went when I said the flag break, when I talked about the flag break. Let's say you added a flag break, you put the stops here. So SPY went from 435 to 441. A millionaire trader bought 1,000 shares of SPY. He risked 435s, maybe he risked lower of the candle. So let's just say he risked $1, just for the sake of it. So he bought 1,000 shares. He risked 1,000. He made by end of day 4,000. What is his risk reward? 1R to 4R. and a trader with small account, he bought 1 share or 10 shares. He bought 10 shares. He risked $10. He made $40. Both of them did the same thing. Both of them have 4 times their reward. So this is what we don't realize. If you want a trade, risk low. If you are chasing, if you want to chase here, and then you don't take the full size, your risk is there, you take the half size. You wanted to make 200, but that's fine. You only added 100 shares, you made 100. How does it make a difference? Your trade became 1 hour or 2 hour. So that, because we are always thinking in a way from the dollar perspective. So risk reward, guys. So risk reward, let's look at that. This guys, I have been, amount of, on social media, amount of time I have been proponent of risk reward, this because of this reason, because it is the most important thing. I always say, find out how much can you lose before you find out how much can you make. If you cannot answer this question, or you do not care to answer this question, you will have better luck in a casino, because it's the same thing, because you don't know how much you will lose. You're just looking how much probably you can make. It's the same thing. You go to the roulette table, you will double if the blacks come, or you will double if the reds come, you will double, right? So you need to know how much you can lose. Analyzing risk versus reward before any investment or trading is priority. The same name can have good returns for someone else, but you can be no returns or a loser. Why? Because someone had a minimal risk. Let's just take example. Let's take example of TTD, right? So I bought TTD here in the morning, right? Or let's say I bought TTD later in the day on this pullback, and somebody else bought the TTD here. For me, it's a good returns. I'm already scaling out. For him, it's not a good returns, right? Because he's making less, because for him risk reward is less. TTD might not be a good example. Let's just take any example, or let's just take win example. Yeah, that's a good. So I shorted right at open. For me, my risk reward was better, but somebody who shorted right here close to this where it started to buy, his risk reward is bad. So a trade can be good trade for someone else and can be bad trade for you, because somebody else risk reward could be much better than yours. You need to understand that. Like someone has heard about a name, likes a stock, bought it randomly anywhere, looking at the risk reward without looking at risk reward, and he may get hurt. Like somebody told you, hey, why don't you buy AI, man? It's a good stock this year. The AIs are going to run. And the person is amateur. He comes and he say, oh yeah, he's an investor. He opens and he just randomly buys AI here at $38. And then he's in a drawdown because he never realized his risk, to reward. This was our swing, from 16, and we were buying 16, 20, where our risk is less. I was buying 20 because of that breakout, because I had my defined risk here. And somebody bought, I still remember, somebody was buying up here, and then he was panicking on the pullback because he never defined his risk reward. So ask yourself before you hit the button, what is my risk? What is my reward? If I am taking, so okay, so people, I was the guy who was telling me that, I can't make these decisions in the morning. It's not hard. Okay. Let's just take a random example. Let's take a Roblox, right? We didn't know that, the Roblox is going to fade, but when it was breaking this, market was weak. I can quickly calculate. And also I will show you later how I will show you in the end how TradingView provides you that. I don't need this. I don't need TradingView to tell me how much I can lose or how much I can make. But this is essentially what I'm saying, right? If I'm shorting Roblox yesterday on the shares, I clearly know this is my risk. So let's say your $100,000 account, and I'm risking $1,000. Then I clearly know if I short here 38, 60, 71, and I will lose $300 or $400 by the time, it goes up here. So I already know that. So I can make that calculation, my risk and my reward. Once I get 1 hour to 1 hour, I can scale out or based upon the targets. So this is what you need to know before you take a trade. Quickly you need to know. If I told you guys, okay, I told you guys in the pre-market prep today that I'm looking for B minus bounce as well. I clearly know my max risk is 21, right? I clearly know I'm buying here. The worst case scenario. My worst case scenario is 21. I clearly know that when I take a position. And when it starts to work, that's when I move my stops up. Then I can probably add. Because if I'm risking $1,000, I know I do a starter position. So this is not hard to calculate. You can see it clearly. Yes, if you just wake up at 9:30 and then you are just looking at 1 minute chart and you are looking at this, which a lot of people do or teach, then you don't know. You don't really know. If you're looking at this is your opening candle, and then you don't know. Let's see. If I'm just looking like this, I don't know. I have no clue where my risk is. Right? I mean, I have a drawing here. If I remove it, you don't know. That's not how you trade. So you need to know your risk right away and reward right away. Reward was so much already. Okay, so what is the reward? Reward was on you. So reward was on you, the complete gap fill. That was the reward, potential reward on you, complete gap fill. Can I get it? Maybe not. I don't know. But I know that can be my potential reward, but I scale out on the way. I follow my system. So $1 was risk and $3 was potential reward. And we adjust that differently in the options. So let's see. Okay. So use technical with your fundamental knowledge to understand where your best risk reward entries are. Always define a risk level. Closer to risk level you add, bigger the reward. When you chase, you skew your risk reward. And if you have to chase, always take 1/3 or 1/4 of position. Okay, risk reward. So your best setups should have best risk reward. Your best setups. Go to the last webinar. What is an A plus setup? What is B minus setup? Your best setups, which are good. Good doesn't mean that you think it's a good company. You think it will bounce. You think that market is a scam. It should fade, and you take puts. No, your system should tell you where your best risk reward is. Risk reward is different for different trades. Buying Tesla here, risk reward is different. Bearish trend. If I'm buying Tesla here, I already admit to myself that Tesla can pull to 205. So I already know my risk. I don't know my reward. It's bearish. I don't know it could push 10 points because it's not even bullish. How do I know what it's going to do? It might just chop all day. It might just chop here all day. So I don't know. So identify those risk rewards, guys. Different trades have different risk rewards. How do you decide about the trend? Establish a smaller time frame. Salman, you need to go. I should expect better from you, man. Our system tells us. Okay, system. Go back, watch the last webinar together, watch some YouTube recaps. Trend. If you can't figure out the trend, you are missing something big. We'll talk about it later. So anyways, concept of scaling in and scaling out will help you proper risk reward. If you are only making R, one loser of 2 hour or 3 hour will wipe everything, guys. So that's why when I tell you do not buy this or do not buy that, of course you do whatever you guys want to. That's my point, because I want you to have a trade where your risk is R and you are making 2-3 R. So that is the point behind that. Because when you take a bad risk reward trade, it's not going to work out long term. You have to find best risk reward trade, the best risk reward trade. They can be spot buys, they can be breakouts, they can be anything, right? In a bullish trade, taking a lot of with your profit money. Where to risk, right? So we use EMAs, we use trend lines, support and resistance, breakout levels, retest levels, 1 hour daily levels, candle range. So we find those risk levels. So we technically find those risk levels, right? Psychological numbers. If I'm buying AMD, if I am an AMD investor, I'm AMD investor. When I bought at 100, I know that 100 is my psychological risk. If I'm an investor and I'm buying here, if I'm a long-term investor, if I'm buying here, let's look at a weekly candle. I know my first risk. For me, even as an investor, I have to buy closer to a support points. I should have bought at 100. I should have bought at 93. You buying here as an investor, your risk is $20. Yeah, maybe because you're trying to make $200 in next 1 year. If and if it's dipping down, you scale in, you take a half position here. Okay, let's just take example of PayPal, which I don't really like because it's super bearish. But let's say you are super convinced that PayPal is the investment for next 5 years. So what will I do? Me, I can tell my risk is $50 because $50 is a psychological number. $50 is a psychological number. And if you are even more bullish than that, you are bullish for next 10 years, then your risk is $30. Okay. You buy PayPal here and you know when it hits 30, you will cut it. So you size accordingly because you only want to, you are in, but the problem is, here is the problem. You're almost giving a 50% risk on investment. That's not really good. So I will do the $50 risk. That still has a chance because 50 is a big level. If I do a fundamental evaluation, yes, PayPal probably is good. And when the rate interests come down, it will be fundamentally also, it will be a cheap. And then I can figure out, okay, 50 is a good level to buy. Closer to that I buy, I'm better. So that's how you calculate your risk reward on time frames. We bought TTD. Rajesh was yesterday in after hours, we were trading TTD. Even if I was buying here, I knew my risk was 50. I started a small size. I thought maybe it pushes to 50 and the psychological buyers will come because I know it will bounce. If it doesn't, I will take a loss. So I started the half size. When it started to stay strong, then I added more, So I didn't have crazy. I had 700 shares, just a tiny size. But the point is that I knew my risk reward. I knew, okay, I wake up early. If it breaks under 50, if I'm buying 53, if breaks under 50, I'm out. I'm out with my $3 loss. Nothing. Scratch. And how much did I knew the gap down is this much from 77 to 52. And how much did I end up make? I took that position off at open and then added later some options and shares for the later day trade. But my risk reward was already risked $3. By the open, it was $10. That's how you trade. If I'm buying in pre-market here for a long-term swing, even then my risk is 50. It's $8 risk. So that is what, guys, this risk reward is. You find those levels, you find those EMAs. If I'm a day trading SPY today, if I'm day trading SPY today, I use 50 EMA as my risk. So if I'm playing the SPY trend, sometimes you do the trend line risk levels, channel risk levels. So you just have to find those levels as a trader, swing trader, investor, whatever you are, you have to find your risk levels. As a day trader, you have to make a quick decision. You do not have luxury of waiting. So guys, the most important thing, position, like PayPal. What do you think about buying shares with the puts, say 100 shares with 10 puts at ATM and monthly option, PayPal phase? Yeah, so that's a completely different topic where you risk manage with puts, right? You buy puts or you sell calls and then you buy stock. So that is completely different topic, Abraham, but that is fine too because you hedge your position. So that's, maybe we'll do some other webinar on that. It's advanced topic, but yes, you can do that. So guys, position sizing, the most important thing, as I said before, remember this, your risk is same, your position size is variable. Your stop range can be variable. Risk is same. Position size, your risk, $1,000 you want to risk, your stops. For the options, $1,000 your risk, your stops into delta. So that this won't really work if you are going too much in OTMs. This concept won't really work because the delta, the volume, it's not the technical, it's not possible. So and this will be skewed. So it works mostly if you're closer to the money or in the money or at least 50 deltas. Because as the price goes away, the delta gets bad and it's not going to recover the same way. So tell me, guys, how many times it has happened with you? You sized 2,000 shares, you stopped out for 20 cents, but that stock went to make $1 move. You lost 400 and you missed 2,000 in profit. If you had just sized 500 shares, remained calm, allowed the room, you would have made 500 on the same move. So tell me, how many of you had this where you were in a stock, you stopped out, and then stock kept running, and you missed it, right? I'm sure happened with a lot, right? Vinod, happened with you today, right? On you? Yeah. Yeah, Microsoft, look at it. It's just beauty, right? So rather than sizing big, you give room. Wherever you add, you size small. That's fine if you are not making more money. At least you are part of the trade. Okay, I want to buy Microsoft. I want to make money on the Microsoft. Okay, that's fine. And I'm right here figuring out when Microsoft is here, what should I do? It's in the trend. It's breaking all-time highs. It is at all-time highs. What should I do? So, okay, I decide that my risk is, let's say my risk is this. Let's say I'm going to risk the low of this candle, or even I want to risk 360. I don't take my 500 shares. I just take 50 shares. Who cares? If the 50 shares pull back here, I lose $50. What? No problem. I'm not going my full size. But with that 50 shares, you would have made $100. So you don't have to always size. So size to give room. If you know your risk is higher, you size small. So that is the problem. We want to size everything in same trade. So that's why the position sizing comes in, guys. I got stopped out in AMD. I see. Yeah. It's eye-opening, and most people do not know what I'm teaching you. Most people do not know, but the professional traders, they do. Do not set stop losses on random percentage or random dollar. That is never going to work, guys. That's the biggest problem. You tell me, hey, Rip, I had a stop loss of 20%. It stopped me out and kept running. I was like, where did the 20% comes from? Who cares your 20%, dude? Nobody cares on your random 20% or dollar. Technicals matter. Technical decides how much you should risk, and that will decide your position size. You can decide how much dollar you want to lose, but your dollar does not define your stop. Okay, so you are telling me that you try to buy AMD here at this candle right here at 117 when it was breaking out of the flag, and let's say you were trying to buying it here. You bought it here and the flag breakout, and you stopped out here because your system says that your account is 2% down, and then you have to cut it. Who cares? AMD doesn't care what your account thing is. The price action tells you that this is the EMA support. This is the solid support, 1 hour support. So it could easily pull back here, right? So you have to let technicals decide. There was a buyer here. There's a buyer at 116.70, 1, 2, 3, 4. And okay, if I take 200 shares or if I take these many options, I will probably lose 300. But if it keeps going, I'll make $1,000. Then you decide. But if you think my account is $10,000 and I can only lose $300 per trade, you have no clue what is stop, what is technicals, what is R. That is the biggest problem with many new traders. Surprisingly, even some investors who are coming, it never works that way. Yes, some investors who don't care about drawdown, that is fine. In a bullish market, that is fine, but not everybody can handle it. If to look at the biotechs, right? Just look at any stock that people want to stay in drawdown. That's up to them. So it's up to them on that they want to stay in like a drawdown. Any stock you take, you might be bullish on some stock which are in pennies, but you never respected your the people who are doing fundamental trading. They accept the drawdowns. They already accept the drawdown. It's up to them. You don't have to agree to them. It's about your risk reward. So if somebody in Apple he's willing to be down 30-40%, that's fine. But you have to decide for yourself. Are you willing to take a drawdown without any rules, or you want to follow the principle? Yeah, NVTA. Yeah. I mean, NVTA was such a good company back in the day, biotech company. If you're a fundamental trader and you are holding it from $8 all the way, that's not like, if somebody is so bullish, that's fine. It's up to him. But you have to decide what your conviction is. If you have done a PhD, you have done like so much due diligence on NVTA that you don't care, okay, that is different. But if I'm an investor and you come to me right now you come to me, I know my risk is 100% on something like NVTA. My risk is 100%. 100%. Because if I'm looking long-term investor, I will throw the money at 36 cents. I will not put a stops at 20 cents. It might go to 20 cents and bounce. That's the fact of it. That's how you have to do it. I like DMTK stock as long term, but I will put my stops at one psychological level and then invest in it. But I wouldn't let it go to 50 cents. That's not how I would do it. That's not my risk reward. I have to have a good risk reward, you know? So that's all. That's what you need to know, how much you can lose. This apps used to be a good stock for us. All right, let me stay on the track, or we go another 2 hours. So position sizing, guys. This you can review later. I haven't waited. I created this long time ago for many people, that what is a good position sizing, what is a bad position sizing, right? There's an example, because if you have same risk, so following position sizing example compares a result with the same risk but different position sizing. This example is applicable to swing trades and day trades. This shows how position sizing with the same risks makes or breaks our trading long term. So let's say your entry is $200, right? And you put a stop at $198. And then your other stop is at $195. So your stop is random. You put a $2 random stop. 195 is actually a technical stop. You gave a room, but you are greedy. You want to make money. You loaded 500 shares. You get stopped out at 198. The stock bounces from 196. You lose $1,000. But you only added 200 shares. You could add 500. Remember, doesn't mean if you can, you should. You only added 200 because 200 into 5,000 risk. Stock went to 196, you were still in. Then went to 210, you made $2,000. So you see the difference. This guy above is just adding randomly at a bigger size because he wants to make more money. And this guy reviewed the charts and he said, oh, 195 is very strong level. Likely it should hold. He was in drawdown, but it was a predefined risk. He was in a drawdown, but it was a predefined risk. And then he went on to make $2,000. Same, this guy, he bought 20 contracts. His stop price was 115. He didn't look at delta or anything like that. He just put a random stop. And this guy, he knew that if stock has moved this much, the contracts can move $1. So he put his stops at $1. He only took 10 contracts. He could have taken 220 contracts, sorry, but then he would have lost so much money there. So the option hits 1-3, bounces. This guy stops out, loses 1,000. This guy, his stops were 1 because he looked at technicals. He made $6,000. Right? So these are the things, right? So this is good position sizing, bad position sizing. Position sizing should always be based upon technicals. Never put stops just based upon risk potential. Put stops based upon technical levels. Based upon technical level, you decide your position using this formula. General rule of thumb is you divide risk by range of the stop and to get the correct position size. For options, you can use delta per contract to figure out the stops. A good position size lets you let your winners run. Just the examples we talked about in last few slides. It lets you learn to be patient. You learn to be better emotional control. That's fine if you're making less money. Who cares? You will win more trades. It's better to win 10 trades and make $1,000 each trade and then make 10,000 in 10 trades. Then try to make 10,000 in one trade. It's not going to work. This guy is mostly a loser trader. And then he's saying market is a scam because it bounced. And he's saying, oh, it always happens with me. Why whatever I do doesn't work? Because he wanted to make quick money. He didn't want to do proper position sizing. He wanted to just scalp it. This guy could hold. He's not worried. He could hold for 210. This guy, probably even if it was working, would have taken off at $1 move. Bad position sizing, large losers, small winners. You lose emotional control. You lose your confidence. You will never able to build, test a consistent system or stick with one system. You struggle for years and your portfolio never grows because you do not understand position sizing. You do not understand your risk. You do not understand your reward. So this slide will be up on the website and you should review it again. So just to go a little bit more in the depth. So for example, right? So this is the Excel I created. So let's say a stock, which is $100, a stock is $50. There is option of $1, $2, $3, $4. Then there's a lot of option, 40 cents, 10 cents. Delta on options is 40 cents, 40 cents, 30 cents, 50 cent delta, 0.1 delta, 0.1 delta. Lotos, you don't care. So the stop is $2, both on $100 stock and both on $50 stock. So let's just say, right, if it's AMD, the stop was, if I was trying to buy here, my stop was $2, something like here, right? Just taking some example. Or if I was trading shop, and then even in shop, my risk is $2. If I'm buying here, my risk is 58, just like a random example. And then I have a bunch of options, right? So I have a bunch of options. There's a $1 option, there's a $2 option, $3 option. My risk is always 1,000. It can change, that changes the whole calculation. So my risk is always 1,000. If I trade stocks, I still lose 1,000. If I trade options, I still lose options. Sorry, I still lose 1,000. I'm always trying to lose 1,000. So my risk is $2. And my size, so it's $2 on both. So I can take 500 shares, right? I am willing to lose 500, but I want to make 2,000. So 2R, right? 2R. So you're risking $2 means that you're making $4. $4 move up. So, and with that $4 move up, you decide what option you are taking. Risking $1,000, this option is $1, and its delta is 4, means my option stop should be 80 cents plus minus. I can only take 12 contracts, not more, not less. This option is $2, delta is same. The price don't matter. What matters is delta and the move. I can also take 12, assuming I have a good size account, I can take 12 contracts. This option is $3. The stock moves $2, the option will move 60 cents because of the delta. And then I can take 16 contracts. This option is $4. Delta is 50 cents. The stop is $1. I can take 10 contracts. I'm still only losing 1,000. F3. This one? No, it's intentional. Remember, it's a $50 stock, but my stop is still $2, right? $48 is my stop. Let's say 48 stop, right? I can just say 48 stop, 98 stop, right? I'm only losing, doesn't matter, it's $100, 50. It's all based upon, yes, maybe my account I cannot buy $100. That's different. I'm assuming I can buy everything, but doesn't mean I size crazy if I can buy everything, right? So the size is based upon how much you are willing to lose. Once you get 1 hour, the rule of thumb is once you get 1 hour, you should scale out, move the stops up. I will talk in the next slides. We still have some time. So the point is, guys, so on the shares, I made $2,000. My this option went 160%. My this option went 80%. My this option went 40%. This went 50%. On Lotos, you see, I'm risking 200 and I'm risking everything. I'm not risking 1,000, but I'm risking everything. I'm buying 200. I'm risking everything because I don't care losing 200. And I want to make at least 100% on the Lotos. This is 40 cent Lotos. I can buy 5 contracts. This is 10 cent Lotto. I can buy 20 contracts. And I want to make that, $400. Let's see. Based upon, so what did, okay, let me, so the $2 stop is here, right? Then $2 stop is here. So let's go here. Let's look here. So let's see if we want to buy AMD. So let's see, long position. So I want to put the stops at 117.85, 115.85. So if I'm putting my stops here and I'm only willing to lose 100, right? So my quantity is 500 because my $2 stop, my quantity is 500. So let's see. Oh, I understand what you mean. Let's see. Yeah, I know what you mean. So for, let's say, let's go to the, what is a $50 stock? Into which is a $50 stock we have? We have Bill. So let's look at Bill when it was $50. Okay, let's go here. So I'm buying Bill and I'm risking $2. Okay, hold on. So I'm buying Bill at 53.24, and then I want to risk at 51.24. So 1,000. So my risk is 1,000, right? So my risk is 1,000 because my stop is same, right? My stop is not, the position size changes when my stop changes. If my stop becomes $4, okay, let's make my stop $4 to 49.26. Okay, then my position size changes to 250 because I'm still losing 1,000. Yeah, but no, but the stop. So my stop is 200. My stop is still 2. If my stop, okay, so if I make, okay, let me just change the example. If I put the $4 stop on a $100 stock, then your size changes to 250. So what I'll upload this Excel. You can play with it. So my size is based upon my stop. Doesn't mean I can not buy more. I can buy more, but I'm not buying more. It's all about how much stop is there. Yes, the one different thing here can be that, yes, $100 stock might have a bigger range. Yeah, if it is a $4 stops, then I'm only going to take 250 shares. So focus on the stop level. All right, guys, running late. Let's move forward. So best entries, guys. If stock is bullish and trending higher, does not mean you can enter anywhere blindly. Wait for the best entry. Focus on your entry, your risk reward first. Does not matter stock is going to the moon. Okay. Always analyze which entry will be least risk or highly confident risk level before any setup you take. Further away from risk, smaller the size. Okay. If you know that stock is going, for example, if you know that this stock is going to 27, let's say you know that it's going to go there and you missed here, you missed you. So you missed you. If you want to buy it here, and if you are buying here, you would have had a bigger size, but now you're buying it away, then you have to buy less shares because you have to give this much room to the risk. If you bought it here, if one person bought it here, if I bought it here, and then I can have a bigger size. Then I have a bigger size, right? But if I'm buying here, you see how the size goes down, right? For the same risk, $1,000, you see, if I got a good entry, I can buy 8,000 shares, right? Because my risk is what? I don't know, 10 cents, 13 cents. But if I'm buying here, this is assuming I know my technical setup tells me that I'm going way here. You get my point? So you see how I'm buying here. I have to buy 1,100 to make how much I'm making, 3,000. If I'm buying here, I can buy 2,700 to make 7,000. I was quick. I had a good entry. So my risk was less. I made a lot. But if I'm buying here, and I'm not saying, this is just an example, I only buy 700 shares because I know the stock that's where it's going, and I'm risking this much. 1-to-1, what is it? It is 1-to-1 risk reward. That's not always good. You want at least this risk reward, right? No, I don't use hotkeys. Best entries is close to the support. Best entries are near consolidation. Best entries are near a good pattern breakout. We've been playing a lot of patterns lately, like on the SPY, NVIDIA, and all those. So that's where the best entries are. Intraday, like today's SPY was a flag breakout. The best entry was here, closer to the risk. And we talk about, guys, if you go watch the last webinar, Trade the Open, I talk about why a setup is good, where EMAs and the support levels are all together. And okay, grading your trades, guys. I explain this to you every day, that B minus, B plus. You have to understand what is a B minus and what is a B plus trade. Based upon your tested and repeatable setups, grade your trades. Some are low probability, you reduce your R on them, you risk half an R, right? You risk less. Some are good probability, you can risk more. They are A plus, A minus. So make a sheet. Anything against the trend, you risk less. If I was buying Tesla, okay, let's say I wanted to buy Tesla. Yesterday, I wanted to buy Tesla or wherever. Definitely, you don't buy here. Let's say I wanted to buy here because I'm seeing some consolidation. It's against the trend. I am not going to do full size. I'm only if my risk was, let's say my stop is what, 215 to 213, $1.50. I want this reversal. I'm going to do 1/3 hour, 1/4 hour, half hour, not full size, because money you make is on your best setups. Because look what happened, you lost. But when I'm doing something like Roku or Roku the other day, when our risk reward was so tight, right here, I can go full size because it's an A plus setup. Or if I know there's an A plus setup, which I know I win every time, all time high breakouts, like was Dual yesterday, I go more risk, I go full size. So make a checklist. More the points, better the grading. Risk more on a good setup, or risk less on a bad setup. So it's pretty straightforward. Okay, option trading, just a quick. Lotos are biggest reason for a loser. Traders throw out the risk management for quick gains. Guys, Lotos, if you're trading Lotos, it's 100% risk. Just like in this Excel I showed you, right? So I risk everything. So stick within the money and close to the money. Like I give you the levels in the morning, you stick in the money, close to the money. Closer to those levels you buy, better it is. If option cannot go 30% at least, do not take it. Calculate it before. Can my option go 30%? Can I make 30%? If I'm taking this one, of course, I don't have any option calculator, but if I'm taking this long and I know my risk is, come on. So I know my risk is on shares, I know I can buy 700, right? I know my risk is what, $1.70, okay, 60, what is 68.91? Yeah, let's say $1. And I'm taking an option which has a 50 delta or 40 delta. I know I can lose 80 cents on that option. But if it goes up, by the time the stock moves $3, that option with the 40 delta will go from $2 to $3.20. So more than 30%. So you need to know your option at least need to make 30% before you take it. If your Lotto cannot go 100%, leave it. For example, if you options today, guys, even I missed that because I was trading shares. The U option went from 6 cents to $1, like 1,000%. It already went to 60 cents. So 6 cents, man, nothing. I'll throw full money. I'll throw $1,000 there, goes to zero. That's fine because it became 5,000. So I already knew that if Unity software pushes this much, the 25 calls will get in money. Let's say 25 calls or 24 calls will get in money, and my Lotto will go 300, 400%. It's not hard to calculate. So you can do that. So don't take that. Always look at the delta, understand IV, theta, delta. We'll talk about in a different webinar. If you go to my website, Ripster Education, Ripster Option Rules, I have a lot of things read up there. Stick with liquid options with tight spreads for best risk reward. Always use option charts for trading, guys. Always, always, always. I'll put one of my option videos in the webinar link for you, or we'll do an option charting webinar, something like that. When you're trading breakouts, you can trade weeklies, but when you are doing swing trading on a support, buy monthlies, longer time frame. Okay, scaling in and scaling out, guys. So this is very important, guys. Always scale in your winners. Based on your setup, start small. If it is working, if the amateur moves turns into trend move, you can add into it. Like I talked about it previously as well. Scale into your winners. We'll do a full different webinar on scaling in, scale outs, just because scaling in and scaling out helps you. Once your trade is moving towards green, take half off. If you are 1 hour, take half off and let the rest run. And if you are seeing that it continues to run and EMAs are continue to hold, then you add into that winner. Not all the plays will be like this. I did this on yesterday. I got out of the duel. I got back in when it reclaimed, right? And when you trade in the morning after 10 a.m., you see something working, you can scale in the winners because there is no risk scaling in the winners. You are just moving your average up and it stops up as well. When a stock moves in your favor, consider selling a portion of your locks and adjust your stop losses to the break even. If you want to chase any play, you have FOMO, take 1/4 size. Who cares? You won't be making the good money, but you will be part of the trade. And the lose won't impact you, like I discussed earlier. Risk management is most important. You need to preserve your capital, guys. So every morning, guys, you wake up, you should promise yourself, today I will not lose. Today I will not today I will not do a bad trade. And then you will preserve. Moving the stops up, taking some profit is done so that winners never become losers. It's hard with the smaller accounts, but a regular account, you can do that. So 50 out. So yeah, I'm 715 entry, stock goes to 1860, the stops moves to 17, makes no sense. 100 shares, you take out 50 at 1860. 50 stops, break even or above your entry. So you have to do that. So how do we manage the risk with EMA clouds? This again, guys, you already know. We talk about it in our previous technicals webinar and Trade the Open webinar. We talked about it. EMA clouds act as a support and resistance. It acts as a trend system. Hold long and scale in the winner as long as EMA cloud holds the 10 minutes, right? So if, for example, let's take SPY today. There was no reason to exit if you followed the SPY trend and EMA clouds. Simple rule. If you had a good entry on the flag break and it's working, you add more here, scale in on the next flag break and ride the trend. I was talking about the ATR. It was still way with the ATR, and then it dipped a little on ATR and then it pushed higher. Yeah. So Nvidia pulled back. Let's say you didn't want to hold it under 512. It didn't really close under it, but let's say you had a small position and you exited, but then you can get back in because market was strong. And the 475 pivot that I talked about in pre-market, and then you scale out on the pushes, you scale back in on this EMA dips, scale out, scale back in. You hold your core position and add into the winners. And so EMA cloud provides you that, right? EMA cloud, that's when it provides you that risk management tool that you can use. On daily charts, 2021 EMA helps you to hold your swings. That's a good concept. Use morning Ripster EMA cloud setups. All the setups I discuss in the other webinar, watch it. It helps you manage the risk. Combine levels and EMA clouds together for the best risk reward. If levels and clouds are together, best. It's the best. We have talked about it again and again on so many trades. If levels and EMA clouds are together, it's best risk reward. Levels and EMA clouds together, support, EMA cloud together, good short. What was the other one we did? Yeah, okay. So I don't know what day this was, but again, the levels and clouds were closer. If the further, again, go to the last webinar. I explained it in the last webinar. Avoid against the cloud trades for better risk management. You already know in the community, I talk about it. Wait for 3450 pullbacks for better entries. Let reversal confirm on 512 or 3450. So today, even if you avoided Tesla, right? Even if you avoided Tesla at the dip, that's fine. Yeah, maybe you added 1/3, 1/4 on the B minus, but once it reclaimed this level, I said that 208 is the level to hold. I mean, that's the support, that's the stop. And then it went all the way. So when the trend changes, use these concepts to manage your risk. Law of the candles, law of the previous candle, range, right? So just some extra tips, guys. One thing you can change course of your trading. Always, always, always buy on the pullback. Pullback to EMAs, pullbacks to trend lines, pullback to range levels. Breakout retest. The other day, SPY broke out. Support becomes resistance, resistance becomes support. Print it on your computer, the golden rule. Use max loss, daily loss. Use max target daily. Focus on weekly, monthly goals, guys, right? And some extra tips: when you're shorting, you just can't short anywhere. First, find your risk level, resistance level, only then short. Closer to resistance, better the short. Just because you can size up in any trade does not mean you have to. If you have unlimited buying or shorting power, does not mean you have to go big size. That's the mistake which blow your account. Look at your risk reward, your R. Look at all that. Before I close this webinar, I made another Excel sheet that I just want to talk about quickly. We're almost. Oh, wow. Sorry, guys, took a little longer. So if you see every day, if you have a target to make $1,000, by end of February, you will make $100,000. Okay. And if every day you make $100, by end of February, you will make $10,000. So think long term, right? And your max loss can be $50. By end of February 17th, you will make $10,000, right? And if you fail to meet that, then you can extend your target. You can extend your target to a further date. So this picture tells you this is overall your trading account per day. So you need to be structured like that on your risk management. If your journal is showing you that you are losing, like if let's say you are supposed to lose 500 a day and you are losing 700, 800, 900, you're doing something wrong, right? You're not making anything. You're not making anything. You know, you're making 200, you're making 100, but you are losing 700, you're losing 300. Stop trading. Stop. Go back, review, see what you're doing. Your risk management is not good. Do that. All right, guys, understand your fixed R. Stick with your R. Stick with the best risk reward setups. Avoid bad entries that skew your risk reward. If you don't get the good entry, let the stock go. There's always tomorrow. Use a repeatable system and setups. Use Ripster EMA clouds to manage your risk. Scale in, scale out. So guys, that's it for today. I hope this was really eye-opening for everyone.